Investing. It's a word that can seem intimidating, especially when you're just starting out. The world of finance can seem like a maze, filled with jargon and complex concepts. But let me tell you, investing is one of the most powerful tools you have for building a secure financial future. It's not just for the wealthy or the financial experts. It's for everyone. It's about putting your money to work for you so you can achieve your dreams, whether it's buying a house, traveling the world, or retiring comfortably. The possibilities are endless when you start investing wisely. Now, you might be thinking, investing is risky, isn't it? And yes, it's true. And you're right, there's always some level of risk involved. But understanding these risks is the first step to managing them effectively. But here's the key. Higher potential returns usually come with higher risk. It's a balancing act. The more you understand, the better you can balance. That's why it's crucial to understand the different types of investments and find the right mix for your goals and risk tolerance. Diversification is your friend here. Think of it like this. Investing is like planting a seed. You start small, but with care and patience, it grows. You nurture it, give it time, and watch it grow into something much bigger. It's a gradual process, but the results can be incredibly rewarding. It's about making your money work for you so you can reap the rewards later on. The earlier you start, the more time your investments have to grow. Ready to start planting the seeds for your financial future? Let's dive in. The journey of investing is exciting and full of learning opportunities. During this video, we'll explore 4 main asset classes: stocks, bonds, mutual funds, and real estate. Each one offers unique opportunities and challenges. Each one has its own unique characteristics, risks, and potential rewards. Understanding these will help you make informed decisions and build a robust investment portfolio. First up, let's talk about stocks. Stocks are one of the most popular investment options available today. Stocks represent ownership in a company. When you buy a stock, you are essentially buying a small piece of that company. With each stock purchase, you become a shareholder, owning a tiny piece of that company. This means you have a claim on part of their assets and earnings. It's like buying a slice of a pie, but instead of a delicious dessert, you're investing in a company's potential for growth and profitability. The more successful the company, the more valuable your slice becomes. So how do stocks make you money? There are 2 main ways: appreciation and dividends. Appreciation is when the value of the stock increases over time. Appreciation happens when the stock price goes up. This can be due to the company's growth, increased profits, or positive market conditions. You buy low, sell high, and pocket the difference. This is the most common way investors make money from stocks. Think of it like buying a house and selling it later for a profit. Dividends, on the other hand, are like bonuses. They are payments made by the company to its shareholders. Some companies share a portion of their profits with their shareholders, giving you a little extra cash. This can be a great way to earn a steady income from your investments. Let's look at a real-life example. Imagine you buy stock in a tech company that's developing cutting-edge software. You purchase some shares of their stock and sit back to watch the ride. As their software gains popularity, their profits soar and the stock price rises. You decide to sell your shares, happy with the profit you made. But remember, just like any investment, stocks come with risks. If the company doesn't perform well, the stock price could drop, and you might lose money. This is the kind of event that makes people fear using the stock market. Stocks are generally considered a higher risk investment than bonds, but they also offer the potential for higher returns. The key is to do your research, choose companies you believe in, and be prepared for some ups and downs along the way. With patience and smart choices, investing in stocks can be a rewarding journey. Now let's move on to bonds. As we said, bonds are a more stable investment option. Think of bonds as loans. When you buy a bond, you're lending money to a company or government. They promise to pay you back the loan amount, called the principal, on a specific date, along with regular interest payments. It's like lending money to a friend, but with a formal agreement and interest payments. Bonds are considered lower risk than stocks, especially government bonds, which are backed by the full faith and credit of the government. They offer a steady stream of income, making them a good option for investors looking for stability and predictable returns. Here's a real-life example. Let's say you buy a government bond that pays a 3% annual interest rate. Every year you'll receive 3% of your investment as interest income. This steady income stream can provide a cushion for your portfolio, especially during market volatility. While bonds offer lower returns than stocks, they play a crucial role in diversifying your investment portfolio and reducing overall risk. Next, let's discuss mutual funds. Strength in numbers. Feeling overwhelmed by the thought of choosing individual stocks or bonds? Don't worry, mutual funds are here to simplify things. A mutual fund pools money from many investors and invests in a diversified portfolio of stocks, bonds, or other assets. Think of it like a basket of investments managed by a professional fund manager. Mutual funds offer instant diversification. Instead of putting all your eggs in one basket by investing in a single stock or bond, you spread your risk across various assets. This diversification helps to reduce the impact of any single investment's poor performance. Imagine investing in a mutual fund that focuses on environmentally friendly companies. The fund manager carefully selects companies committed to sustainability and renewable energy. You get to be a part of their success without having to research and choose individual stocks yourself. The risk level of a mutual fund depends on the types of investments it holds. For instance, a stock mutual fund will be riskier than a bond mutual fund. However, the diversification offered by mutual funds generally makes them a more moderate risk investment option compared to individual stocks. Building wealth with real estate. Last but not least, let's talk about real estate, a tangible and potentially lucrative investment. Real estate has been a cornerstone of wealth building for centuries, offering a unique combination of stability and growth potential. Real estate investing involves buying properties to generate income or sell for a profit. This can include residential homes, commercial buildings, or even land. It's a hands-on investment that can provide both financial and emotional rewards. The process of improving a property can be deeply satisfying, and seeing your investment grow can be incredibly fulfilling. There are two primary ways to make money in real estate: rental income and property appreciation. Each method has its own set of strategies and benefits. Rental income is the cash flow you receive from tenants renting your property. This steady stream of income can help cover your mortgage, taxes, and maintenance costs. It's like having a side hustle that pays you every month. Over time, as you pay down your mortgage, your rental income can become a significant source of profit. Property appreciation is the increase in the value of your property over time. This can be influenced by factors such as location, market demand, and improvements made to the property. As demand for housing rises, so does the value of your investment. This can lead to substantial profits when you decide to sell. Let's imagine you buy a rental property in a desirable neighborhood. The location can significantly impact your rental income and property value. You rent it out to tenants, and the monthly rent covers your mortgage payments and other expenses. This allows you to build equity without using your own money. You're essentially using someone else's money to build equity in your property. Over time, this can lead to significant wealth accumulation. Ideally, the property value increases over the time you hold it, and you decide to sell it, making a tidy profit. This profit can then be reinvested into new properties, further growing your wealth. Real estate can be a rewarding investment, but it's essential to remember that it also carries risks. Market conditions can change, and not every investment will be a home run. Property values can fluctuate, tenants can be unpredictable, and unexpected repairs can cut into your profits. It's crucial to do thorough research and have a solid plan in place to mitigate these risks.